margin called. Never. Once you understand these metrics, you will never get margin call. Because again, what you do is you guys, you look at your maintenance requirement and you look at how much debt you owe. Good evening, you guys, and welcome to the channel. I wanted to, quickly share with you some of the fundamentals and basics of understanding margin and your available to withdraw. After the end of this video, you guys, you will finally understand the metrics and how to understand the calculations behind how margin is calculated so that you never get margin called. Stay with me to the end, and if you find any value in this video, feel free to like and subscribe, and I'll see you in the next one. Okay, you guys, so here is my balance detail sheet on my Charles Schwab. The first thing we're going to look at, you guys, is here. The available to withdraw. Okay, when you go on the available to withdraw, you will see exactly right here, you guys, I have $141,000 available to withdraw, which is essentially saying I can borrow that exact amount against my assets and use it as collateral. This is my true line of wealth. Similar to a credit line, you guys. This is my true line of wealth that I can use instead of going to a bank or some sort of traditional bank. Okay. Now, you guys, the most important thing is this. What are the margin details with regards to being able to borrow against my assets that my broker is offering me? So one of the main things is this. The first thing you want to look at, you guys, is the maintenance requirement and the margin rate. So the margin rate here, you guys, is specifically showing 8%. So every day or every time I have margin debt, you guys, I'm incurring interest on a daily basis. I'm incurring interest on a daily basis. And this is going to be a margin rate of 8%. Okay. Now, this is the APR, you guys. I'm getting charged 8% on a yearly basis. Okay. Remember that. Now, going into margin debt, you guys, this is how we want to calculate margin debt. And this is the most fundamentally sound ways of understanding margin debt. We're going to give an example. Let's say we've invested $100,000 into QQQM. Okay. We want to look at the maintenance requirement for QQQM. If I type in QQQM, QQQM has a link below showing a margin requirement. Specifically shows 25%, you guys. So we have a 25% margin maintenance requirement. This is essentially saying, hey, whatever equity, whatever amount of equity we have based off the amount of debt we take out that we borrow against QQQM, we need to make sure we have a 25% buffer before we're getting margin called. Okay. Now, what we're going to do is this, you guys. We're going to even go more dumbfounded here. We're going to go to Thinkorswim. We're not going to do any math right now. We're just going to go straight to our portfolio and we're going to ask our broker, what is our margin maintenance requirement? Our margin maintenance requirement is going to be something where we have to keep our market value, our account value above that maintenance requirement so we do not lose our assets. Going here, you guys, you will see the maintenance requirement on my portfolio is $69,000. $69,000 in comparison to the net asset value worth of $273,000, you guys. So what this is saying, you guys, is I have a net asset count value of $273,000. That is my market value. I must keep it above $69,000 or I will get margin called. Right now, I'm in $6,100 in debt. And everything is right here for you to see too, you guys. I am $6,100 in debt. Now, we're going to take this a step further. Let's say, for instance, you guys, we have $100,000 in QQQM and we want to borrow $10,000 against this asset. So we're going to pull from our available withdrawal and borrow against that asset and use that money for whatever we need. Now, you guys, this is the fundamentally sound basics we need to understand when it comes to margin. Now, we can go as basic as ever and just look at the maintenance requirement, because then this will adjust. This will more likely increase because we are borrowing more money, right? So when we have $100,000, we're going to times that by 25%. So that would be 100,000 times 0.25. So here, you guys, we'll do a quick math. 2 times 2.5. We'll go here. It looks like we have an available $25,000 maintenance requirement, you guys. $25,000 maintenance requirement is the math. Now, you guys, let's say this. Now that we know our margin requirement, we need to keep a buffer of $25,000 in comparison to the amount of debt we took out. We essentially need a $25,000 buffer difference between the debt we took out and the amount of equity we have. Because remember, equity is the current market value minus the debt. And we need at least a 25% maintenance, a buffer, before we get margin called. Before Charles Schwab says, hey, you know what? You're getting too close to your margin debt, and you're getting close to that 25% maintenance buffer that you need. That's when we become at risk of losing our assets, you guys. Okay, so let's just say the market drops to, we'll say, you know what, let's just say the market, right, dropped to $20,000, and we still owe $10,000 worth of margin debt. Now, let's do the math, because now our equity changes. Our equity, again, is the current market value minus the debt. Okay, current market value minus the debt. And we need to keep a 25% maintenance minimum buffer. Okay, you guys. So what we do in the math is, you guys, is we're going to do $20,000, which is our new market value, guys. $20,000 is now our new market value, times 0.25. That's going to equate to $5,000. $5,000 is basically the margin maintenance requirement and the buffer that we need to stay away from our $10,000 in debt, you guys. So essentially what it's saying is, hey, if you start to go below this $5,000 worth of equity, you're at risk of getting margin calls, because you still owe $10,000 and the market value is already down to $20,000. Charles Schwab is saying, hey, we need to make sure we get our $10,000 back. And this is where we're at risk of getting margin called, you guys. That maintenance requirement is essentially a buffer in comparison to how much debt you are in. Okay? So once you understand those metrics, then, you guys, you will more likely never get margin called. Never. Once you understand these metrics, you will never get margin call. Because again, what you do is, you guys, you look at your maintenance requirement and you look at how much debt you owe. The market here on my portfolio, you guys, the market would have to drop substantially, because then I need to keep a 25% maintenance buffer before it gets to $6,100. This is a huge drop in the market. That's like the market dropping from $273,000 all the way to $15,000. I need to make sure I keep a 25% maintenance. So as the market is dropping, you guys, my maintenance requirement will change. And this is important, guys. This is why I went through this deep fundamental detail with you. You always want to look at your debt and your equity. Your current market value minus your debt equals your equity. And then you need to keep at least a 25% maintenance minimum of equity versus how much debt you have taken out. Once your debt to equity collides with that 25% maintenance buffer, then you will be at risk of getting margin called. Okay, you guys, I want you to understand this. Okay, so that's going to be it for today, you guys. If you guys found any value in this video, feel free to like and subscribe, and I will see you in the next one.